Well, hello, and with all the volatility happening in the market, do you want to have some fun? So, I created this fun trading system. So, stay tuned and learn what it is. Okay, so welcome again to the systematic trading educational videos. I'm posting at least one video a week for the next foreseeable future. Probably I will even accelerate a little bit more, but don't just exactly take what I do and do it on your own. Make sure to do your own due diligence. I'm not a financial advisor, so take it with a grain of salt, especially for this video specifically today. So, the thought that came across to me with all that volatility, I really don't want to trade right now as much. I have my systematic trading, they're trading all the systems, but it goes up and down like crazy. I don't want to watch it as much. So I want to stay away from that volatility for a moment. So I was like, okay, let's do some fun. And what if we'll create a system which will work off of the index just to test things out? Okay, what will happen? And that's what happened. So here's the fun system. I just plugged in S&P 500 index data. So once again, it's not ETF, it's not futures, just an actual index data. Okay, so I have the data for the index. So I plugged it in and I try to run that as a day trading system, meaning that we will get in during the day and we'll get out at the end of the day no matter what. And that's it. We're not going to hold anything overnight. That's it. That's the system. So right in the first try, it's a very simple system. It has two rules, literally two rules. I'll show you what the rules are a little bit later. But two rules, and it generates this 23% average compounded annual returns and only 29% drawdown. It's like, that's nice. So, and especially if I zoom into the tariff pause announced on Wednesday, right? I think it was Wednesday, as I recall. And you can see how that system outperformed everything. But don't get fooled too much, because if I zoom into the last 3 years, you can see that yes, it's performing. It's actually making some money, but it's not like outstandish system. I mean, it's good, but it's not really that great system. So here's all the returns, and if you have good glasses and you can read these little numbers, especially if you're watching on your phone, good luck with that. But otherwise, it just you can see that sometimes it outperforms the index, sometimes it's underperformed the index. But right now, it's outperforming the index a lot because the index is 10% down for the year with all that volatility and craziness. But this system would have been up 2% for the year. So that's just a little information. Now, here are the rules. Grand opening. Two rules. We have unstop order. We get in on unstop, meaning that the market has to go in our direction, the one that we want to go. It's a long system, so it needs to go up. And once it triggers, we get in and we get out at the end of the day as market unclose. That's it. Two rules, right? Actually, in essence, it's just one rule, but two rules. So we're using the previous day closing price as my on-stop order. So if the market, let's say, gapped down during the night and then opened up, we have this on-stop order sitting from previous day close. And if we go up and hit that on-stop order, that's when we will trigger the position. And then at the end of the day, whatever happens, we get out. That's what you saw before. Now let's have some fun. I mean, this is it. Like this, as much as the system is, like it's as simple as it can get. Like simpler that you cannot imagine, right? The two rules: you get in and you get out at the end of the day. Okay. Now let's have some fun. I said, okay, what if I'll plug in other indices? What if I'll plug in the Russell 1000? Okay, it's 1,000 stocks in U.S. market by market cap. So it's a little bit bigger than S&P 500, obviously, because S&P 500 it has only 500. And in one of the other videos, I was showing you guys that S&P 500 is a good proxy to the overall market. So we'll see what will happen if we'll plug in Russell 1000 index. And my K-curve jumped up to 30%. And my maximum drawdown jumped up as well to 40%. And you can see where the drawdown is happening. It was mostly happening in 2008 time period. And then it just picked up and just keep going up and up, and the drawdowns are very, very tiny. Only like 10% is the maximum drawdowns, as you can see over here on this bottom chart. And then, what if I plug in Russell 2000? So it's the small cap, micro cap stocks. So it's the next 2000 stocks after the Russell 1000 by market cap. So they are literally small caps and micro cap stocks. And you can see that my CAGR went pretty much the same way. It's 39%, I mean some more, 39% and 20% maximum drawdown. But you can see that the chart of the drawdown is different. So my maximum drawdown is half what it was with the Russell 1000 with all the larger cap stocks and medium cap stocks. But the price action is slightly different, obviously, and because of this, my drawdowns are bigger sometimes. In other cases, like instead of 10%, it's like it reaches 20% right here in recent history, in 2025 specifically, actually. What if I'll do combine? Russell 1000 plus Russell 2000 becomes Russell 3000. Think of it as the first 3000 stocks in the US market, which is not exactly a total stock market, but it's very close to be treated as if it's a total stock market, because anything past Russell 2000, these are micro cap, nano cap stocks. You probably don't want to trade them anyway. I mean, there's some industry where people trade those, but normal people, retail people, you really don't want to dive into those stocks because they're too volatile, too specialized, very hard to trade, moving crazily. So that's why we're taking, let's say, first 3,000, and you can see that my CAGR, my compounded annual growth rate, is very close to Russell 2000, 39 and 20 maximum drawdown. So all in all, this is a pretty fun, interesting exercise as a system that even with these two very simple rules, you can get very interesting results. And I said, okay, what if I'll change, and instead of having one day, basically the previous day closing price, what if I'll pick the highest out of the 3 closing prices from previous days, or 7 highest, or 14. So basically, whichever one is the highest, that's the one we'll get in. And you can see this, the system is still pretty stable. I mean, it's not performing as well as when it was the previous day closing price, but you can see how it's still pretty stable. The drawdowns actually improve a lot, especially the version where it was 3-day closing price. My drawdowns went to be 8% only, while I'm keeping the 20% returns on average, right? So this is compounded annual growth rate. When it goes to 14 days, then it really slows down. My drawdowns are still the same 8%, but my returns are 6%. So it's like, okay, not really doing much, but it's working there. So now it's a fun little system, fun little exercise, but keyword, it's an exercise. It's not a system that you can trade as it is, because you really cannot trade an index unless you're some kind of a huge fund where you can replicate what the index does. But so in this case, I haven't tested it on futures, and futures have a different way of handling things. So I don't know if it's going to be replicated exactly by futures, and futures is your best bet to replicate what the system does. I mean, another way of doing it through the options, but it's for very sophisticated people if you want to do it. Like there's options on the futures or options on the index. So you can try to do it this way, but keep in mind that it's not as easy, especially with options. They're not as liquid, and you will have slippage. And this is a day trading system, so it has a lot of frequency. And if it slips on price, then it may degrade the performance a lot. But as an exercise, it's pretty interesting system. It does look like it has an edge. I have tested it on ETFs. And ETFs don't look, it looks like they don't have an edge. They're really just slowly draining systems. I mean, they're going down, down, down consistently. Like on spikes, there are some spikes, let's say, it would have been the nice spike on Wednesday, but otherwise it's just a completely draining system, so they go down to almost zero. So they're not really, so do not try to trade it with ETF. At least this particular type, where you go on stop from previous day close and then you close for the day. There is a difference between basically the bars between the SPY, which is the S&P 500 ETF, versus the index, S&P 500 index. So the bars are not identical, just so you know. They're close, but they're not identical. They're close between day to day to day to day, but they're not identical during the actual bar. So keep that in mind. They're not identical, and that's where it's like as if it loses all that edge because of this not proximity to be identical in this case. And that is why I'm saying that this is the educational video. In this particular case, especially, do not try to use it directly. Once again, I have not actually traded it myself. I just went and used it as an exercise to see if there's an edge with this very simple rule. I was testing something for different our software, and I was testing, and as a test, I had to use this approach, and that's where I by accident discovered. But otherwise, be my guest to explore more. And obviously, I'm using this software to test things out. So if you do have questions, either book a call if you really want to know how we do things, how we work with systematic trading, how to combine systems together, or send me an email to info@tradingsystems.com, and I will reply back to you personally. Lawrence might as well, but most likely it's going to be me replying to you. So don't be shy, ask the question, and otherwise, have a good day and see you next time.